Before getting into the results, I would like to begin by thanking our over 37,000 colleagues who have served our 12.2 million customers with distinction in a difficult operating environment. I would also like to thank our external stakeholders for their ongoing loyalty and support of our business. Turning to our results, I will first share my thoughts on the current operating environment before giving an update on how our organization has fared strategically. I will spend time on our financial performance before handing to Chris to go through our performance in detail and provide our guidance for 2024. Thereafter, we will provide an update to our medium-term guidance and take your questions. The global, sub-Saharan and South African economies entered the year on increased uncertainty. At the beginning of the year, very high inflation prompted central banks to continue raising interest rates, though fears of an economic slowdown were moderated by the continued stronger-than-expected labour indicators and financial markets. Inflation has moderated recently, but remains persistently high and will likely see policy rates remain higher for longer. Geopolitical tensions remain elevated across the globe with the Russia-Ukraine conflict, strained relations between the US and China, and more recently, the conflict in the Middle East. Supply chains were already constrained by the Russia-Ukraine conflict, and the recent attacks in the Red Sea have only added to these pressures. Turning to our arrow markets and the tight global financial conditions, weaker commodity prices and high inflation and policy rates weighed on economic activity. Debt sustainability remained a key focus in some large markets, although the appetite for recent bond issuances, as well as the recent progress in debt restructuring negotiations, has seen some improvement in the outlook. Foreign currency scarcity has been a particular challenge for several countries across the continent. Economic performance was varied, with East African economies generally faring best, although performance in our presence countries remains well above growth in South Africa. The South African economy faced this difficult external environment along with its own internal challenges. Although it avoided a recession in 2023, albeit with growth of only 0.6%. I will look at South Africa more closely, given its position as our biggest market, and it is evident that the operating environment remained challenging throughout 2023. Load shedding reached record levels in 2023, although the reconnection of 3 units at Kusile in the second half of last year has seen a reduction in load shedding levels, with levels in the 3 months to the end of January being 45% less than the prior year. Business has also responded strongly to the lifting of the generation licensing thresholds, and we expect this to further alleviate the pressure on Eskom going forward. Unfortunately, the logistics infrastructure constraints are likely to drag on for longer. Freight rail volumes in 2022-2023 were down a third from the highs of 2017-2018. While the recent port congestion at the Durban and Cape Town ports highlighted the potential devastating impact on other sectors of the economy like resources, retail and agriculture. These infrastructure challenges are weighing on business confidence, with the latest private sector sentiment published by the Bureau for Economic Research at 30, which implies that 70% of businesses are dissatisfied with the prevailing business conditions. The SA consumer came under increasing financial strain in the year. Headline inflation remained above the SARB's target range for the majority of the first half of the year, before falling below 6% by mid-year, and subsequently oscillated in the top half of the central bank's target range for the rest of the year. In response to this, the SARB increased the repo rate by a further 125 basis points in the first 5 months of 2023, in addition to the cumulative 350 basis points increase in 2022. This, together with a higher cost of living, and muted wage growth further eroded consumers' disposable income. Consumer pressure is likely to remain elevated in the near term, at least until interest rates start to reduce. In August, I mentioned the alignment between government and business on delivery of key interventions in areas of energy, transport and logistics, and crime and corruption. This collaboration has seen progress since its inception 9 months ago, but we need to capitalize on the momentum and urgently implement the necessary reforms to see tangible progress in creating a sustainable and inclusive economy. Our strategy remains consistent, and we are confident that it remains relevant, and as I will show later, our consistent execution against it has created a solid foundation as we strive to become a leading Pan-African bank. Furthermore, we remain confident that the medium-term targets supporting the strategy remain relevant, and I will spend more time on this at the end of the presentation. Before getting into the 2023 results, it is important to unpack what has fundamentally changed within the business following our separation from Barclays plc. I will do this on a business-by-business basis. The RBB SA business in 2018 was in material decline across all major metrics, including customer numbers, digital usage, and balance sheet market shares, with performance supported by unsustainable pricing structures. The business followed a systematic approach in correcting the fundamentals, starting with regaining our fair share of the balance sheet market, whilst our customer experience, pricing and propositions, and digital channels were redeveloped. In addition, the bancassurance business was integrated to create seamless customer journeys. Our CIB business in 2018 was primarily a South African business, following an asset-led approach, and required a shift to becoming a more diversified Pan-African business with a stronger client franchise. In Arrow RBB, business was heavily focused on 4 key retail markets, with our product proposition out of date as consumers within the Arrow markets increasingly became more digitally focused. The systematic approach to fixing the businesses within the old RBB SA construct focused on 3 key areas. These being creating value for money propositions, integrated digital and data enhancements, and creating a seamless and empathetic customer experience. Over the past 3 years, the business has eliminated 1 billion rand in fees that were punitive to customers and redeveloped the product propositions across the spectrum. This has seen a dramatic turnaround in customer perceptions, with 65% of surveyed customers rating Absa as best value for money. Our digital efforts have been noticed by customers, and they have become more comfortable transacting on our digital channels. Transactions on our Absa app have increased by over 200% since 2018 to 2.7 billion transactions in 2023, while digital sales have increased significantly to account for 22% of retail sales from 3% in 2020. These changes, together with a more empathetic customer engagement, have been recognized by customers and have seen customer experience scores, a key measure of how customers perceive our services and products, improve by 30% since 2020. Our efforts on franchise health are translating into tangible progress in the customer franchise, as we are seeing growth in customer numbers as well as deeper relationships with our existing customers. Acquisition levels have improved across all areas of the business, with new-to-bank retail transactional accounts increasing by 21% in 2023, with growth in the youth segment, a key focus area, growing by 38%. Turning to our relationship banking business, it is pleasing that new account sales have increased by 42%, largely driven by the SME segment, which increased 48% year-on-year. The integration of the bancassurance model across both the life and non-life businesses into the banking customer journeys has seen continued traction, with over 978,000 standalone policies sold in 2023. These improvements in acquisition levels are converting into customer number growth, with our active customer numbers increasing to 9.8 million, having increased each year since 2020. This has been supported by active transactional customer growth, which grew by 4% to 5.8 million customers in 2023. These systematic changes have proven effective in deepening our relationships with customers, with new to reward sign-ups increasing by 81% since 2018, with 31% of existing customers moving up a tier in 2023, while the number of digitally active customers has increased by 20% annually since 2018 to 3 million customers. This has all translated into the average product holding per customer improving to 2.64 in 2023 and indicating that customers on average have 0.2 products more than in 2018. In line with the strategic ambition announced in 2019, our CIB business has diversified into a Pan-African business with a stronger client franchise. This has been anchored by the build-out of the corporate banking franchise over the past 5 years, with this business now constituting 47% of revenues in 2023, while client acquisition continues to be strong with about 500 new clients added in 2023. The diversification into a Pan-African CIB business has gained traction, with CIB Arrow now 42% of revenues, although there is still some way to go to achieve our target of 50%. The business continues to build global corridors for our clients, and the imminent opening of our office in China will allow us to be closer to existing clients as well as establish new relationships with clients across our markets in Africa as we connect trade and investment flows into Africa. The diversification of the business into transactional banking and Africa has led to an improved returns profile with a return on regulatory capital of 23.9% compared to the 17.8% in 2019. Our Arrow RBB business has seen a strong turnaround since 2018 as we have created a more diverse and sustainable business, although there is some way to go still. We have successfully diversified the business from a reliance on our top 4 markets, and our efforts to grow business banking are on track, with its contribution growing to 28% of revenues. Improved propositions as well as focus on customer experience has seen customer numbers grow by 11% on a compound annual basis since 2018. Customers in our Arrow markets are consistently becoming more digitally focused, and our efforts to reinvigorate our digital propositions through various initiatives, including digital onboarding, have seen digital customer numbers more than double since 2018. Reducing the cost-to-income ratio in Arrow RBB has been a key focus over the past 5 years, and I am pleased to say that we are starting to see progress from our efforts to leverage our existing infrastructure and digitizing client transactions where possible. This has seen our cost-to-income reduce from the mid-70s to 66.7% in 2023, although we see further productivity benefits within this space. An engaged colleague franchise is one of our competitive advantages, and our efforts over the past few years are being recognized. The launch of our group purpose, values, and the ICAIA staff incentive scheme in September, whereby over 35,000 colleagues became shareholders in our group, has created an increased sense of commitment and accountability across the business. This has been reflected in our colleague engagement survey, where we saw further improvement across our various categories for the 3rd straight year. Our colleague engagement levels are at their highest ever, as evidenced by our employee NPS improving to 36% from 12% in 2021, whilst we have seen retention of top talent improve. We have invested heavily in our employee development, with 65% of our spend focused on critical, scarce, and future skills to ensure we have the required capabilities now and in the future. We have made progress on diversity and inclusion, with our black senior management representation improving by 2% year-on-year to 58.5%, while we increased our female representation by 1% to 39% at senior management level. Our progress in advancing our organizational culture and people practices to sustain Absa as a great place to work has been recognized through various awards, including the top employer certification in 5 countries for the 3rd year in succession, with a score of 87.1% against the global benchmark of 85.2%. As I said in August, we want to be an active force for good in everything we do, specifically within our 3 focus areas of climate, financial inclusion, and diversity and inclusion. Pleasingly, we have made progress across all 3 of these areas over the recent past. We continue to maintain a leading position in sustainably linked finance, with over 84 billion originated in the last 2 years. We see significant growth in the space over the medium term as we contribute to this national and global imperative. We have made progress since our net zero commitment by setting 2030 targets to reduce our financed emissions in coal, oil, and gas sectors. Our commitment to assist the unbanked and underbanked populations to achieve financial inclusion and accessibility saw the launch of Chat Wallet, a secure WhatsApp-based digital product with no monthly charges, while our mobile branches, digital solutions for small businesses, UIF support in our ATMs, and affordable housing loans have also made an impact. Lastly, our efforts in diversity and inclusion included a program in Kenya where over 35,000 women participated in a mentorship program for women-led micro, small, and medium-sized enterprises. All of this has resulted in an Absa Group in 2023 that is a very different business to 2018 and is in a much more resilient position to weather tough economic impacts. Looking at this in a bit more detail, we have strengthened our balance sheet with both capital and funding and liquidity ratios having improved since 2018, with these now at the top end of our board target ranges, despite our balance sheet growing by 43% since 2018. Since 2018, we have significantly improved the contribution of our ARO operations from 20% pre-provision profit to 29%, aligning with the more attractive economic growth, while our CIB business increased to 32% from 28%, with growth in both Africa regions and South Africa. These focused efforts to diversify our business stood us in good stead in 2023, given the pressure on the SA consumer and the muted economic growth in South Africa. A key strategic shift in 2018 was to reignite revenue growth that had been relatively pedestrian in the period leading up to that point. Over the last 5 years, we have grown revenues at 7% on a compound annual basis, while ensuring that we create an appropriately efficient business, as can be seen by our cost-to-income ratio declining to 52.1% from the 58% levels in 2018 and 2019. Moving to our 2023 performance, it is fair to say that our earnings were below the expectation we had set for ourselves as we entered the year, as the operating environment deteriorated more than what we initially anticipated. Earnings growth was muted at 1%, but it was pleasing to see pre-provision profit grow by 6%, driven by 8% revenue growth, which is similar to our trajectory in the recent past and highlights the positive growth momentum we have created. Our cost-to-income ticked up slightly in the year to 52.1%, largely driven by investments in the sustainability of the franchise, with growth in marketing and frontline staff hires. Our credit loss ratio increased to 118 basis points from 96 basis points and was above our through-the-cycle range of 75 to 100 basis points, largely from increased consumer strain in the SA retail portfolios. I will spend a bit of time on our credit performance, but Chris will unpack it in more detail. To understand our credit performance, we need to reflect on the trajectory of the retail portfolios pre-separation from Barclays. As I explained earlier, we were losing market share across customers and the balance sheet in the period leading up to 2018, In fact, our retail advances flow market share in the period between 2012 and the end of 2017 was only 4.5%, resulting in our overall market share declining by over 3% in that period. To arrest the decline and reconnect with customers, we needed to grow our balance sheet, and this was done in a measured way, with our flow market share in the period from 2018 to 2023 at our deemed fair share of 24.5%, which is similar to the starting market share position in 2012. This means that our retail lending books are relatively young and need to mature, which they started to do in an orderly manner in 2021 as the rate environment gradually reverted towards a hiking cycle. However, the impact of rates increasing from 7.75% to 11.75% from March 2022 to May 2023, as well as inflation averaging 7.5%, created a shock for consumers, which is evident in the current delinquency profiles. Whilst our impairment charges are elevated, these vintages are still profitable on a risk-adjusted margin basis, and we expect them to be profitable over time. This doesn't mean that we haven't taken proactive action in the portfolios. On our front books, we have responded with appropriate risk management cuts to higher risk categories within our unsecured portfolios, while affordability buffers have been increased, particularly in secured lending. We also proactively invested in our collection capabilities in 2022 as we built capacity, as well as rolling out digital capabilities to support our collections and recovery teams. Chris will spend some time on it later, but it is important to note that while our structural interest rate hedge provides margin stability over time, it has been profitable for the group since its implementation. This very stability it provides was a headwind to earnings given the rapidly increasing rate environment, as we couldn't offset the elevated impairments with a positive endowment impact. Despite this, our hedging strategy remains a key component of our long-term financial architecture. Our return on equity of 15.3% was lower than 2022's 16.4%, reflecting the low earnings growth, but remains above our cost of equity. However, we believe our underlying returns were better than the 15.3%, given the impact of some significant items in 2023 that Chris will touch on shortly. For our shareholders, the dividend per share increased by 5%, which is faster than earnings growth, as we increased our payout ratio to 55% in line with our guidance. Looking at our business units briefly, the benefit of having a diversified franchise is clear when looking at earnings performance. The Product Solutions cluster had a divergent performance, with the secured lending business impacted by the higher impairments. The insurance businesses grew strongly on new business volumes and lower claims. Market sentiment in secured lending remains low. The businesses are focusing on quality production while working out the non-performing loans. At the same time, the insurance businesses continue to further integrate and leverage the bancassurance opportunity. Everyday banking has seen traction in customer acquisition and is deepening relationships through the empathetic customer experience and its revised propositions I discussed earlier. However, the focus is on accelerating this trajectory now that the fixed phase of the strategy is over. The reorganization of the relationship banking business into a segment-led business was completed in 2023. The segment-led approach, along with the investment in additional frontline capabilities in 2023, has shown some improvement in its leading indicators, and this is expected to continue into 2024. The CIB business continued to show strong momentum in 2023, and its diversified construct helped to deliver strong earnings growth despite the impact of currency dislocations, particularly in Nigeria. The business has momentum behind it, specifically in the African regions, and will look to continue growing its key focus areas. Momentum in the Arrow RBB business continued into 2023 with strong customer acquisition and improved efficiency. However, the returns in this business remain below its cost of equity, and the focus in the medium term is to generate a return above the cost of equity. As I said earlier, we remain committed to our strategy and we continue to consistently execute against it. We maintain our orientation towards growth as we work towards delivering our medium-term targets.